Well, the Trump train comes to a grinding halt as drama builds over the potential failure of the American Health Care Act, otherwise known as the Obamacare replacement, and whether it will actually make it out of the Republican-controlled House of Representatives. Now, if the bill fails, the ramifications, of course, will be wide and far. Replacing Obamacare is the linchpin of the Trump agenda, and for many reasons, they say it had to come before other parts could be achieved. Now, of course, in addition to the almost $1 billion in tax savings, removing those roadblocks to small business growth, lowering the federal debt, passage of the bill would have signaled smooth sailing for all the other parts of President Trump's economic agenda. And let's face it, the root of this spectacular improvement in business and consumer confidence is a belief that the wheels of commerce would be lubricated with lower taxes, fewer regulations, and having a cheerleader for success and optimism in the White House. Now, I honestly don't think Wall Street cares about how the final Obamacare package looks. They really don't. They just want it to be over and done. Now, ultimately, the stock market does revolve around corporate earnings, and while I personally look for companies that are growing the top line organically, they've got pricing power, they're expanding their margins, they're taking market share, lowering taxes would have an instant impact, a huge impact on bottom lines. In fact, some models suggest an automatic increase to the S&P 500 of almost 10% at a 20% rate and almost 13% if you can get the rate down to 15%. Beyond the fact that this was the first broad market decline of more than 1% in 64 trading days, by the way, the best streak in 50 years, key Trump stocks and sectors, by the way, took it on the chin. For instance, things associated with the wall and infrastructure. Those darlings got hammered. U.S. Steel down 9%. U.S. Concrete down almost 4%. And then stuff associated with Dodd-Frank financial reform. Goldman Sachs, the darling, down 2.3%. And you had the indexes. The big bank index down almost 5%. Your regional banks were down more than 5% on the session. Now, of course, let's face it, the market was due for a pullback. In fact, I've been trying to prep everyone with my market commentary lately. But those who have just gotten back into the market and you're afraid, well, golly, this is tough, I'm not sophisticated, you're going to blow it by taking unnecessary losses. That said, here are your worst-case scenarios, I think, right now for your major indices. On the downside, the S&P 500 be another 2.8%, 3%. Let's call it 2278. That's got to hold. For the Dow, I think the key number would be around 20,100. That's another 3% to the downside. These are worst-case scenarios. Listen, I love it when stocks go on sale. Now, I would admit that modeling a sharp reversal lower in sentiment would make things a lot more difficult. But on that note, I do see a majority of President Trump's policies going into effect. The realities of Washington, though, is that there's sometimes no such thing as smooth sailing. The fact is, though, the market is never smooth sailing, right? And you're going to have a change of fortunes from time to time. The key is not to panic. Ride it out. I think this is overall the beginning of what's going to be an amazing ride to the upside. So do not panic. In the next couple days, I'll have some ideas for you to buy on weakness.